You have probably heard the news by now. The government just gave seniors a $6,000 tax deduction. The headlines said it. Your neighbor mentioned it. Maybe your financial advisor sent you an email about it. And for millions of retirees drawing Social Security right now, the story sounds simple. Washington finally did something for us. Most of us are not going to owe taxes on our Social Security this year. Problem solved. I need you to stop right there, because that version of the story is missing three things. There is an income threshold that phases this deduction out completely before many retirees even realize they have crossed it. There is an expiration date buried in the fine print that almost nobody in the financial press is talking about. And there is a decision that millions of retirees are making right now, today, this month, this year, because they believe the new deduction protects them. And that decision is going to generate a tax bill they are not expecting, and that nobody warned them about before they made it.
Here is what keeps me up at night. The deduction is real. For a lot of retirees, it is genuinely good news. But good news with fine print you have not read is exactly how legal money becomes an unexpected tax bill. And the people who are going to get hurt by this are not people who ignored the new law. They are people who heard about it, thought they understood it, and made a financial decision based on an incomplete version of what it actually says. I am going to make sure you are not one of them. My name is James Whitfield. I am an enrolled agent with over 20 years of experience representing taxpayers directly in front of the Internal Revenue Service. What I am about to walk you through is not a summary of what the headline said. It is the actual mechanics of what the one big, beautiful bill does to your Social Security tax picture, where the traps are, and exactly what you need to do before your next filing decision to make sure the new rules work for you instead of against you. There is no version of this conversation your financial advisor is going to start with you. Most of them have not read the full bill. Most of them are still working from the summary that came out when it passed. And the difference between the summary and the fine print is exactly where the problem lives.
Before I get into the rules, I need to tell you about a client of mine. I am going to call her Sandra. Sandra is 69 years old. She lives outside of Columbus, Ohio. She spent 32 years as a high school librarian. She retired at 66 with a modest pension, Social Security of about $1,950 a month, and a traditional IRA she had been carefully building for 3 decades, with a balance of just over $210,000. Sandra is not wealthy. Sandra is careful. She reads the news, she pays attention, and when she heard about the new $6,000 senior bonus deduction from the One Big Beautiful Bill, she did exactly what a careful person would do. She called her broker and asked a question. She said, if I take a larger withdrawal from my IRA this year, does the new deduction cover the extra tax?
Her broker said yes, the new deduction gives you $6,000 of additional room. So Sandra took a $40,000 IRA withdrawal instead of the $22,000 she had originally planned. She had a roof that needed work. She had been putting it off. She figured this was the year to do it, while the deduction gave her extra protection. 9 months later, Sandra sat across from me with a tax bill she did not understand. The $40,000 IRA withdrawal had pushed her total combined income above the phase-out threshold for the senior bonus deduction. The deduction she was counting on had been eliminated almost entirely before it even applied to her return. On top of that, the higher combined income had pushed the taxable portion of her Social Security from 50% to 85%. One decision. 2 tax hits, neither one necessary. Sandra did nothing wrong. She asked a reasonable question and got a technically accurate but dangerously incomplete answer. The deduction does give you extra room. What her broker did not tell her is that the room has a ceiling, and that ceiling is where everything goes wrong. That is what I am going to walk you through today. Let me start with what the One Big Beautiful Bill actually says, because most of what you have heard about it is the headline version. The bill was signed into law on July 4th of 2025. It is an 870-page piece of legislation that touches almost every area of federal tax policy. The part that matters most to retirees drawing Social Security is a provision called the senior bonus deduction. Here is what it does. Starting with tax year 2025 and running through tax year 2028, taxpayers who are 65 or older can claim an additional deduction of $6,000 per person on top of the standard deduction and on top of the existing age-based additional deduction that was already in the tax code. For a married couple both over 65, that is $12,000 of additional deduction. And here is the part that sounds remarkable. You can claim it whether you take the standard deduction or whether you itemize. That is unusual, and it is genuinely beneficial. The White House estimated this deduction would benefit roughly 33.9 million seniors. And for middle-income retirees whose total income sits in the right range, it effectively eliminates the federal tax on their Social Security income entirely. That is real and that is significant. But here is what the headlines left out. Every single word of it.
First, the deduction is temporary. It covers tax years 2025, 2026, 2028, and 2028. After 2028, it expires. Unless Congress passes new legislation to extend it, every retiree who restructured their financial plan around this deduction will face a significant tax increase in 2029 that nobody warned them was coming. I will come back to this because the planning implications are enormous and almost nobody is talking about them. Second, the deduction phases out at higher income levels. For single filers, it begins phasing out at $75,000 of modified adjusted gross income. For married couples filing jointly, the phase-out begins at $150,000. This is not a cliff where you lose the deduction all at once. It tapers. But for retirees who are close to those thresholds, a single financial decision, an IRA withdrawal, a Roth conversion, a pension lump sum, the sale of a property, can push them over the line and eliminate a significant portion of the benefit they were counting on.
Third, the underlying Social Security taxation formula was not changed, not by one word. The formula that determines how much of your Social Security benefit is taxable has been in the tax code since 1984, and the One Big Beautiful Bill did not touch it. Your combined income still equals your adjusted gross income plus any tax-exempt interest plus half of your Social Security benefits. If your combined income exceeds $25,000 as a single filer or $32,000 as a married couple, up to 50% of your benefits are taxable. If it exceeds $34,000 single or $44,000 married, up to 85% of your benefits are taxable. The new senior deduction reduces the tax you owe after that formula runs, but it does not change how the formula runs. And for retirees in the higher tier, with 85% of their Social Security already counted as taxable income, the deduction helps, but it does not come close to solving the underlying problem. It is a discount on a bill that should not exist in the first place. But for now, it is the law.
And before I move on, I need to address one more thing. You may have heard about a bill called the You Earned It, You Keep It Act. This is a proposal that would eliminate federal income tax on Social Security benefits entirely. It has been discussed in Congress. It has significant public support. As of today, it has not passed. It is not law. And I am telling you directly, do not restructure your retirement income strategy around a bill that has not been signed. Build your plan around the law that actually exists. If the You Earned It, You Keep It Act passes, your plan can be adjusted. But making decisions today based on legislation that may never become law is how good intentions become expensive mistakes. Now, let me walk you through the 3 hidden traps. These are the specific situations where the new rules hurt retirees who thought they were protected. Trap number 1, the phase-out cliff that nobody mentioned. Sandra's story is trap number 1 in action. The senior bonus deduction sounds like a blanket protection for all seniors. It is not. It is income tested. And the income test uses modified adjusted gross income, which means it counts every dollar of your IRA withdrawals, your pension income, your capital gains, and the taxable portion of your Social Security.
Here is the specific danger. A retiree with $60,000 of combined income as a single filer is well below the $75,000 phase-out threshold.
They receive the full $6,000 deduction. Good news. Now, that same retiree decides to take an additional $20,000 IRA withdrawal to cover a home repair, help a grandchild with college, or execute a partial Roth conversion. Their modified adjusted gross income is now $80,000. They are $5,000 above the phase-out threshold. The deduction begins disappearing, and the higher income simultaneously pushes more of their Social Security into the taxable tier. The retiree made a decision that felt protected because they had heard about the new deduction. They were not protected. They had crossed the ceiling without knowing the ceiling existed. Before you make any withdrawal decision this year, you need to know exactly where your modified adjusted gross income sits relative to the phase-out threshold for your filing status. That calculation needs to happen before you call your broker, not after. Trap number 2, the 2028 expiration nobody is planning around.
This is the trap that will hurt the most people, and the one that is getting the least attention right now. The senior bonus deduction expires after tax year 2028. That is 2 full years from now. After that, unless Congress acts, it is gone. The danger is not that retirees are unaware the deduction is temporary. Most people who have heard about it at all know it is temporary in a vague sense. The danger is that retirees are making long-term financial decisions. Decisions about how much to withdraw each year, when to convert IRA funds to a Roth, how to structure their income in retirement, based on the assumption that this deduction will still be there in year 3, in year 5, and year 10. It will not be. Not unless Congress extends it. And we have no way of knowing whether Congress will extend it, when or on what terms. The correct approach is to treat the deduction as a 2-year window, 2027 and 2028, and use those years deliberately. If you have IRA money you were planning to convert to a Roth over time, the next 2 years, while this deduction exists, are the years to execute the portions of that conversion that make sense within your threshold. If you have large discretionary withdrawals you were planning, consider front-loading some of them into this window, rather than taking them in 2029, when the deduction no longer softens the tax hit.
The window is real. Use it deliberately. Then plan for it to close. Trap number 3, the combined income formula that the new bill never touched. This is the trap that exists underneath everything else, and that the new deduction only partially addresses. The formula for how much of your Social Security is taxable has not changed since 1984. In 1984, the $25,000 and $34,000 thresholds for single filers made sense because $34,000 was a meaningful income. Today, a retiree with a small pension and a modest IRA withdrawal can easily clear those thresholds before they have drawn a cent of Social Security. The thresholds have never been adjusted for inflation. Not once. What this means in practice is that the majority of middle-income retirees, the exact people the senior bonus deduction is designed to help, are already in the 85% taxable tier before the deduction applies. The deduction reduces the tax on that 85%, but it does not change the fact that 85% of their Social Security is being counted as income in the first place. For a retiree receiving $24,000 a year in Social Security, 85% taxability means $20,400 of that benefit is counted as taxable income before a single other source of income is considered. The $6,000 deduction helps, but the underlying problem, a formula that was designed for a different economic era and has never been updated, remains entirely in place. This matters for planning because it means the deduction is not a solution. It is a discount on a bill that continues to exist. And planning as if the discount solves the problem will leave retirees exposed when the discount expires. Here are the 4 protection moves to put in place before your next filing decision. Protection move number 1. Calculate your combined income before touching your IRA. Do not make a single withdrawal decision this year until you have calculated your total projected combined income. Add your adjusted gross income from all sources. Add any tax-exempt interest. Add half of your projected Social Security benefit. That number tells you how much of your benefit is taxable. Then separately calculate your modified adjusted gross income and compare it to the phase-out threshold for your filing status. The distance between your projected income and that threshold is your safe withdrawal room for the year. That is the number that should be governing your decisions, not the $6,000 headline. This calculation takes 20 minutes with your most recent tax return in front of you and a tax professional beside you. It is the single most important thing you can do before the end of this calendar year. Protection move number 2. Do not use a Roth conversion to burn through the deduction.
I have had multiple clients come to me this year with the same idea. The new deduction gives me $6,000 of extra room, so I'm going to use that room to convert more of my traditional IRA to a Roth. The logic sounds right. The execution is dangerous. A Roth conversion adds directly to your modified adjusted gross income in the year it happens. If that addition pushes you above the phase-out threshold for the senior bonus deduction, you lose the deduction and trigger higher Social Security taxation simultaneously. The conversion that was supposed to be sheltered by the deduction ends up costing more than it saves because the deduction disappeared the moment the conversion crossed the threshold. If you are planning a Roth conversion this year, map your total projected income, including the conversion, against the phase-out threshold before you execute. If the conversion keeps you below the threshold, it may be a smart move. If it pushes you over, the math changes significantly and the decision needs to be revisited. Protection move number 3. Use 2027 and 2028 deliberately.
These are the last 2 full years of the senior bonus deduction before it expires. Whatever discretionary financial moves you have been considering, partial Roth conversions, larger IRA withdrawals for home improvements or family support, restructuring how your income is sourced in retirement, the next 2 years are the window to execute those moves at a lower after-tax cost than you will see again after 2028. This does not mean doing everything at once. It means mapping out which moves make sense within your phase-out threshold in each of the next 2 years and sequencing them deliberately. That is a conversation to have with a tax professional who has read the actual bill and not just the summary. The planning window is real and it has a hard end date. Protection move number 4. Build your plan around the law that exists today. I said this earlier and I am saying it again because it is the most important planning principle I can give you. The You Earned It, You Keep It Act has not passed. Do not build your retirement income strategy around it. The senior bonus deduction expires in 2028. Do not build a 10-year plan around a 4-year provision without accounting for what happens when it ends.
The retirees who will be in the best position in 2029 are the ones who used the deduction strategically in the years it existed and built their income structure to be sustainable without it. The retirees who will be in the worst position are the ones who restructured everything around a temporary benefit and never planned for it to disappear. Plan for the law that is in front of you today. Adjust when the law changes. That is the only approach that does not leave you exposed. Let me bring this back to Sandra. A simple calculation before she made that phone call to her broker would have shown her that a $40,000 withdrawal pushed her $8,000 above the phase-out threshold and cost her the vast majority of the senior bonus deduction she was counting on. The roof still could have been fixed. The withdrawal could have been $15,000 this year and $15,000 next year, staying under the threshold in both years and preserving the full deduction in both years. Her total tax across 2 years would have been significantly lower than her tax bill in the single year she took the larger withdrawal. Same roof, same money, entirely different outcome. The only difference was knowing the ceiling existed before she made the call. That is what this channel is here to do. The One Big Beautiful Bill is real. The senior bonus deduction is real. For millions of retirees, it is genuinely good news. But good news with a phase-out threshold, an expiration date, and an unchanged underlying formula is not the simple gift it was presented as. It is a tool. And like any tool, how you use it determines whether it helps you or hurts you. You have the information now. You have the protection moves.
The only thing left is to sit down with a tax professional before the end of this year and run the numbers for your specific situation before you make any decision that cannot be undone.
If this video helped you understand something the headlines did not explain, hit the like button. That single action tells the algorithm to show this to more retirees before they make the call Sandra made. Subscribe if you have not already, because next week I am releasing a full breakdown of the 3 Roth conversion mistakes that are costing retirees the most money in 2026 under these new rules. And if you know someone who has heard about the new senior deduction and is already planning around it, send them this video before they make their next withdrawal decision. The fine print is real, and now you have read it,